Topping our news tonight, violent revolutionary protests erupting around the globe. Anti-government demonstrators have taken to the streets in Ukraine, Venezuela, and Thailand. Investors everywhere are closely watching those deadly clashes and hoping things will stabilize, especially as European officials meet tomorrow for an emergency session in Brussels. Now, the biggest hotspot, Kiev, Ukraine. There's no let-up to the violence and the death toll in that city's Independence Square as protesters who want closer ties to Europe and the U.S., but clash with others who want to be aligned with Russian-backed government. In Washington today, President Obama warned Kiev of consequences over the escalating violence there, saying the military should not engage in a situation that can be resolved by civilians.
The United States condemns in strongest terms the violence that's taking place there. We have been deeply engaged with our European partners as well as both the Ukrainian government and the opposition to try to assure that that violence ends.
That tough talk may have worked. Late today, a truce was declared between the two sides in the Ukraine, calling for the beginning of negotiations aimed at ending the bloodshed. But no signs of peace in Bangkok. Protesters there battled riot police as they try to oust Thailand's prime minister amid accusations of corruption. And in Venezuela, a sea of white as tens of thousands marched against the government, angry about the killing of protesters last week and the arrest of the Harvard-educated opposition leader, Leopoldo Lopez. Government supporters were also marching, calling the protesters traitors.
One American company says the political and economic turmoil in Venezuela will cost it. Colgate-Palmolive warned it could book one-time losses of up to $200 million, or 19 to 20 cents a share, because of currency moves the Caracas government put in place covering foreign businesses. Procter & Gamble previously trimmed its fiscal 2014 profit forecast because of the devaluation of Venezuela's bolivar. Colgate finished the day lower. P&G closed higher.
And a warning today to all emerging markets from the International Monetary Fund. It said developing nations, India and Turkey in particular, need to tighten up monetary policies and make some structural economic changes to settle market turmoil and stave off inflation and the even greater threat of deflation in Europe.
Joining us now to talk more about what the political and economic unrest might mean for markets large and small around the globe is David Kelly. He's chief global strategist at J.P. Morgan Funds. David, how much, if at all, do I need to be worried about what I'm seeing in the Ukraine, Thailand, and Venezuela?
Yeah, I don't think investors should overreact to this. There are specific political issues in each of these countries which are all quite different. And I don't think they really talk or speak to a systematic problem in emerging markets. And if you look at Turkey and India, I know the IMF say they need to tighten monetary policy. Well, they have been tightening monetary policy. And in fact, we've seen some stabilization in the last few weeks. So I think that the biggest mistake investors could make here is overreacting to these events and staying out of emerging markets, which I still think are a very good long-term investment.
All right, so right now it seems like okay to you, but could it possibly develop into a much more volatile situation, in which case, what is the contagion risk?
Well, I think that's really why the fact that there are more political issues than economic ones is so important. This is not because they've got so much debt in most cases. It's really because of political disagreements in Thailand and Ukraine, and then very irresponsible economic policy also in Venezuela. But it doesn't sound like a global financial crisis in emerging markets. And remember, last year, while the U.S. equity market went up by 32%, emerging markets actually went down by about 2%. So over the course of a year, we've devalued emerging market stocks by 35% to U.S. stocks. You've got to ask yourself, well, in the long run, did things change that much? I mean, what this has left, it's left emerging market stocks looking very cheap by most metrics. And I think long-term investors should think long and hard about avoiding that area. I think it's actually a very good area for long-term investment.
So you say buy?
Yeah, absolutely. Buy for the long run. I mean, I don't think you should invest in stock markets for short run. I think in the long run, there's a lot of opportunity in emerging markets, but you need to do it with don't just pick a country, and also do it with a good investor who knows how to miss some of the potholes.
So buy a fund, buy
a
fund, buy an ETF, and play the demographic play, which favors the emerging markets.
I think a fund more than an ETF, because an ETF is going to be forced to mirror some indices which in some cases are dominated by commodity companies or state-owned companies in some emerging markets. But a good, well-managed emerging markets fund, I think, should do well in the long run.
Let's bring it back home here. There have been a lot of concerns about what's going on with the U.S. economy, also concerns about today, some of these minutes that came out of the Federal Reserve. How is the U.S. economy doing? It seems like all the data we've been getting recently has been tainted by the bad weather. Is that something temporary, or is there something more long-term going on here?
Well, I hope the weather's temporary. I mean, we're building an igloo out in our backyard right now. But if when the weather lets up, I do think the economic statistics will get better. As we look at them, there does seem to be a little bit more than just weather in the last few months. I mean, we're not seeing enough perkiness in the housing numbers, the auto sales numbers. I do think that some of this is part of a long-term slowdown in the supply side of the U.S. economy. But still, I think things will pick up after the weather clears here. And most importantly, I think growth will be strong enough to keep the unemployment rate coming down, to keep interest rates moving up, to allow earnings to rise somewhat. So I still think it means rates will be higher this year, and probably U.S. equity prices will also be higher. So it's still time to be a little overweight equities versus fixed income within the United States.
David, thank you very much. Common Sense tonight from David Kelly, Chief Global Strategist at J.P. Morgan Fund.